Hey, welcome to another week's Current Federal Tax Developments here. Current Federal Tax Developments, as always, are brought to you by your state society of CPAs and Nichols CP Incorporated. And we're going to be taking a look at all the neat little things that have happened this week in the area of federal taxes, hopefully giving you some idea about what you can use in your practice. Current federal taxes this week, some of our key developments that we're going to have. We're going to look at the fact that the IRS's reach extends all the way to the high seas, we'll discover this week. We also find yet another conservation easement deduction bites the dust for a technicality. We'll take a look at how that happened this week. The health savings account limits for 2017 have come out now because you can't start planning too early. And we discover that very little is actually going to change here. After a series of errors, the IRS granted a taxpayer permission to undo what turned out to be a larger than desired Roth IRA conversion. California's donor disclosure law that was found constitutional on its face a year ago was found to be unconstitutional in operation. And we'll also talk about the fact that we're going to have one more year of not having the actual tuition payment information that we need on the Forms 1098-T we'll be receiving for 2016 tax year, as the IRS grants educational institutions a one-year reprieve from having to put the amounts received rather than amounts billed on Forms 1098-T. And Current Federal Tax Developments is a weekly presentation brought to you by your state societies of CPAs and Nichols CP Incorporated. We have a number of courses coming up this week, or I should say this month, because we enter May, being brought to you here by those of us here at Nichols Patrick. I have a series of courses coming up in Arizona and Washington coming up early in the month, a business and industry tax update on the 9th of May in Phoenix, 2 courses in Bellevue, Washington on the 10th and 11th, one on identity theft information security and one on fringe benefits. Also on May 11th and then on May 11th and May 12th, Don Cochran is going to start his presentation year with some courses in Michigan. And he will have investment taxation, the Medicare tax, and beyond on May 11th. And May 12th, a course on tax research systems and methods. Mark Patrick will be presenting some conference sessions in Ohio in May. On the 19th and 20th, he'll be presenting at the Dayton Accounting Show information on the new tax laws and what exactly did Congress do. On the 24th, he'll be at the presenting a federal tax update at the Columbus Springs CPE Day. And on the 26th, he will go ahead and also present that same federal tax update in Youngtown at the Youngtown CPE Day on the 26th of May. Also on the 26th of May, I'll be presenting on tax research systems and methods in Beaverton, Oregon, just outside of Portland. And the following day on the 27th, assisting the survivors of the decedent's estates. Your state societies offer a number of courses, not just those I mentioned here, but also other courses in other areas with other qualified instructors. Be sure to take a look at those catalogs you're receiving now and sign up for courses that hopefully will help you serve your clients better. Let's go ahead then and get started this week on what's actually happening in the tax law. And we'll start out with another conservation easement that bit the dust. This is the case of Carroll versus Commissioner 146 TC number 13 42716. As a reported tax court decision, it tells you pretty well that we found a new way to destroy a conservation easement, and that's what happened in this case. In this case, remember, a gift of a conservation easement is one of the few times when a taxpayer can give a partial interest in an asset and claim a full charitable contribution deduction. But to do that, you've got to meet some very specific requirements. One key requirement is that the gift you give to the charity must be in perpetuity and protected in perpetuity. Now, a special provision provides that if for some reason the easement is terminated for conditions beyond anyone's control, it simply becomes no longer, accessible because, let's say, a state takes back the property and uses it under eminent domain, so the easement simply doesn't apply. There have to be special rules that provide the charity's interests are protected. Generally, those rules provide that when that happens, the charity has to be paid out a proportion of the fair value of the property at that date that is equal to the proportion of the value of the conservation easement at the date of gift to the fair value of the property at that date of gift. In this particular case, the language of the easement provided a provision that said that the fair value at the date of gift for these purposes will be treated as the amount the IRS allowed on an exam or on the tax return, eventually allowed if it's not challenged by the service what was there. If it is challenged by the service, then whatever number it was, we finally decide the value should be. So the idea was that we would be able to claim it if the IRS came in and said, that easement was not worth $500,000, it was only worth $400,000, then we'd use $400,000. Now the IRS said, wait. This said whatever was allowed by the IRS. What happens if your deduction is totally disallowed for reasons totally unrelated to the value of the property? For instance, remember a year ago we had a taxpayer who got themselves in trouble and lost their easement because they failed to have the mortgage company subordinate their rights to the property beneath those of the charity. They didn't get that waiver ahead of time. The tax court agreed with the IRS and said, look, this thing could end up being zero allowed deductions for items that have nothing to do with having the wrong fair value of the easement. The court pointed out that, in fact, the IRS in this case had raised other issues besides the question of whether it was properly valued. So the court said because of that, and because the value could be set to zero for reasons that have nothing to do with the fair value, the language did not comport with the regulations requirements that the charity's interest in the fair value be protected in perpetuity. And because of that, the court found that there was no deduction to be allowed for the conservation easement. The key issue here is you cannot get creative in this area. Understand the IRS has gone after these, and part of the reason is because, to be quite honest, there was a lot of very heavy promotion of easements that kind of did them fast and loose for many years. When the rules came out, the IRS notices things like that, begins examining, and starts playing it very, very much like you must follow the rules exactly when we have a situation like that. If you have a taxpayer trying to give a conservation easement, you better make sure all the I's are dotted, all the T's are crossed, and everything is done right in line. Do not get creative with things like, in this case, the language in the document about that protected right. Next up, we're going to talk about the fact that the IRS actually brought out the new health savings account amounts for 2017. And effectively, nothing much changed. This is Revenue Procedure 2016-28, issued on April the 28th. The contribution maximums for this year are going to have the one thing that will change, and only for single cover. The single maximum contribution for 2017 will rise to $3,400 from this year's $3,350. A whopping $50 extra can go into the HSA if somebody has coverage only for themselves under the high deductible health plan. Family coverage maximum contribution will remain at $6,750. The deductible minimums, it'll be $1,300 for a single individual, same as this year, and $2,600 for a family. To have a high deductible health plan, your deductibles, you have to have nothing essentially except for the allowed payments, which generally are for preventive care and some other minor details. Nothing else can be paid until your expenses exceed $1,300 for single coverage, $2,600 if you have family coverage. That's the same as 16. Also, the maximum that the policy requires somebody to pay out of pocket has to be capped at $6,550 for a single individual, $13,100 for a family. The real takeaway from this is virtually nothing is changing for 2017. The numbers there will look very much like the 16 numbers, so just get used to it. Inflation has not been running at a very significant clip in recent years. Therefore, a whole bunch of inflation-adjusted items like this simply aren't moving. Next up, this is going to be a series of errors that the taxpayer was able to unwind by asking the IRS for permission. In this case, we have Private Letter Ruling 2016-17019, issued on April the 22nd. What happened in this case was the taxpayer was trying to do something. Now, we're all kind of aware of the fact that for historical reasons and how the law is developed, we have a weird rule on Roth IRAs. An individual may be ineligible to contribute directly to a Roth IRA if their adjusted gross income, modified adjusted gross income, exceeds certain limits in a year. But there is no longer any limitation on converting a regular IRA to a Roth IRA. And there's never been a limitation on making a regular IRA contribution. There's a limit on deducting it potentially, but no limit on making a regular contribution. And you can convert any regular IRA to a Roth IRA. So what many taxpayers end up doing is they go ahead and make a contribution to a regular IRA that is non-deductible, because if they're over the limits, if they're covered by a retirement plan, their contribution will essentially effectively as well be non-deductible. They can't make a deductible contribution, but we'll go ahead and we'll make that contribution. Then shortly after establishing the regular IRA, we will go ahead and convert that regular IRA to a Roth. If we do that, effectively, we're going to be able to make the Roth contribution. If it is a deductible IRA, then we get the deduction and we go ahead and we pick it back up. If it's non-deductible and we have other IRAs, it gets a little more complicated because we're considered to have proportionally coming from each. But depending upon our basis in our other IRAs, maybe not a whole lot of difference in how things work. We may end up having to pay a little bit of tax. We may end up being a little differently situated, but we'll go ahead and we'll take that contribution. We'll have to pay some tax on the deemed earnings we're transferring. In any event, this is what this taxpayer wanted to do, it appears. He set up he had an IRA already existing, traditional IRA already existing. He wants to make a contribution to a Roth IRA, or at least put money into it. I would assume, obviously, the PLR doesn't go through this because it's irrelevant to it, but apparently, most likely, the taxpayer could not make a contribution due to AGI. So what he did, he wanted to set up a brand new IRA account with the custodian, put his contribution into that account, and then come back and convert that account to a Roth IRA. So let's say we have an account with, Bank A, and we tell Bank A establish a second IRA account, regular IRA account for us, and we want this money to go into that second account. Well, unfortunately, the financial institution got confused and they put this contribution into the regular IRA account, the one he already had. Now, the taxpayer, of course, then sends a notice telling them to convert an account to a Roth. Well, they've only got one account. And so rather than just converting the amount he contributed, they converted the entire amount of the IRA. And as you can imagine, if there's a lot of money in that IRA, this is a much larger conversion than you expect would happen. But the errors don't stop there. Later on, so we have this large IRA that gets converted rather than just the amount that we wanted to convert, which is what we put in this year. At the end of the year, the bank issues a Form 1099-R. The 1099-R reports a taxable distribution for the full amount of that IRA, but reports an exception applies. For some reason that's not clear, the tax advisor somehow felt that exception apply rules meant they just converted the amount that he had put in rather than the whole thing. We're not quite sure how that confusion happened, but in any event, they didn't report the full conversion. Obviously, the IRS got the 1099-R, saw the entire amount that should have been taxable, didn't see any rollovers anywhere else that would cover this, and they saw the whole amount going to the Roth IRA, so suddenly they're sending a letter asking for taxes. Now suddenly everybody goes back and figures out what happens. The taxpayer asks the IRA, files a private letterling request, and asks the IRA for a right to do a late recharacterization. Had the advisor caught the problem, the taxpayer could have said, wait, I didn't mean this. They could have recharacterized the transaction, essentially undone the entire transaction, backed everything back to the regular IRA, which is frankly what they'd want, and then go ahead and do a conversion the next year and straighten out and do a conversion for the right amount. The IRS agreed that the taxpayer, clearly this wasn't what the taxpayer meant. The taxpayer, had they been told about the right to recharacterize, would have recharacterized. So the IRS granted the right to undo this transaction. The one piece of bad news, you can only get this relief if you ask the service for it. And when you ask the service for it, you have to apply for a private letterling request and you've got to pay the user fee. So there's the downside. Presumably, the numbers here were large enough to justify doing that, because I've got to assume we're not just talking here about he converted $3,000 too much. Those numbers wouldn't support the fees for the private letter request and all the hassle. We have to assume that there was a major error that took place here. Next up, we revisit an issue that we talked about last year. This is the question of the state of California requiring not-for-profit organizations to submit their list of donors to the state. And this time the case is Americans for Prosperity versus Harris, the United States District Court for the Central District of California, 117 AFTR 2nd, paragraph 2016-644. The case was decided on April the 21st. A year ago, we discussed the Ninth Circuit held that the California requirement to submit the list of donors for nonprofit organizations to the Attorney General's office was not facially unconstitutional in the Center for Competitive Politics versus Harris. That was 115 AFTR 2nd, paragraph 2015-703. Now, what the Ninth Circuit has said was that it's okay, there is a valid state purpose in needing to know the donors, and that it did not on the face of it have a chilling effect on the right of association, because those donor lists were to be kept secret. However, this other case, Americans for Prosperity versus Harris, it obviously was appealed to the Ninth Circuit because the court had said that it was unconstitutional. The Ninth Circuit sent this back after they made their decision in Center for Competitive Politics, stating that, based on that, it's not facially unconstitutional, so the way the court arrived at this decision was an error. But the court noted that the Ninth Circuit had held in Center for Competitive Politics that even if this was not unconstitutional on its face, depending upon the way it operated, if it actually did put the right of association at risk because the information was not being held confidentially, was not being held basically and kept confidential, then this statute could still be effectively unconstitutional. And in fact, the panel that returned the case to the court in Americans for Prosperity versus Harris strongly hinted that that probably was the case. The district court, taking its cue from the panel's statement, found that California's procedures were just simply unable to keep this list confidential. It's not good when the plaintiff is able to produce a list of 1,400 Schedule Bs from Form 990 that were available publicly on the state of California's website, because the Attorney General's office had not managed to take those out of the packets that were submitted. The Attorney General's office is supposed to remove those because it's supposed to keep them confidential, but a former head of the organization, a former head of the office that ran this, admitted that it was very tedious work. Lots of errors were made. They were understaffed and there weren't enough people. The court found that, in fact, they were not keeping it confidential, and the court also found that various individuals who had contributed to this organization were facing specific threats that were based on the fact of their association or contribution to this organization, which the court felt therefore showed actual damage to the right of association. And the court found basically that because the state couldn't keep it basically confidential, and the state's procedures had not apparently improved in any way to suggest they could do it in the future, that the court was not allowed, that the court was going to pull that right. It was, as I said, it was rather embarrassing. And in fact, the plaintiff even came in on the date of trial and brought 40 more after the state had supposedly pulled the ones, they pulled the 1,400, they found even more, some of which includes from various organizations, including they found the donor list for Planned Parenthood was nicely posted on the website. So the court found that, California, you're just not I don't care, the law says keep it confidential, you're not doing it. That affects the right of association. Sorry, guys. In essence, American for Prosperity is not required to provide its donor list to you. Next up, we have the case of Wilson versus Commissioner, Tax Court Summary Opinion 2016-19. In this case, the taxpayer lived in Mexico, but he actually served on container ships. He was a sailor on container ships. Those ships left and returned from port in California. They spent most of their time in international waters. Sometime, though, they would spend in waters, territorial waters of other countries or other ports. The taxpayer had excluded all of this under the foreign earned income credit. The IRS came back and said, no, 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 you can't do that. And the court said that's correct. To get the foreign earned income credit, you must have had earnings during a period when you were in an area that's under the jurisdiction of a country other than the U.S., not just in an area not under the jurisdiction of the U.S. Time in international waters does not count. And this taxpayer spent most of their time in international waters. The court allowed them the portion when they were in foreign ports or foreign waters, but they did not allow the international. Now, the IRS also went after a penalty on this taxpayer for a substantial understatement of tax, which he will meet the mechanical test. But the court noted that the IRS had examined this taxpayer before on this issue. They had allowed the deduction. The taxpayer had provided all information to his longtime 20-year preparer, his preparer he'd used for 20 plus years. The preparer had taken the position, the fact that he gave all the information to the preparer, the fact that he had survived exams before where the IRS had never raised this issue, said it was perfectly reasonable for the taxpayer to have had this reporting position. The court refused to basically charge him with a penalty. Finally, some of you may have thought, hey, it's great. We're going to finally get on the 1098-T, the amount paid for the year, so that we don't have to go ask for additional information from our clients when we're trying to get education credits. Well, that was part of the PATH bill this year. But announcement 2016-17, you're going to have to wait a year to get this. The PATH bill required educational institutions to have to report the amount that the student had paid, not the amount, just the amount billed on Form 1098-Ts, beginning with the 2016 tax years, the ones that we'll get next year. Now, education institutions had complained that their software was not set up to do this, that they had to modify software, and they would not be able to get that software modified in time for next year's reporting. In fact, they started saying this virtually as soon as Congress passed the law. We started hearing these complaints. The IRS has acceded to the request and said, you know what, we'll go ahead and we'll accept that. They will not penalize institutions on 2016 Form 1098-Ts if they report the amount billed and not the amount paid. Now, that's great for the educational institutions, but there is another problem in play. Congress expanded the due diligence rules, which previously applied to the earned income credit, to apply to any taxpayer who claims the American Opportunity Credit, and the due diligence rules apply to the preparer who must show that they got sufficient information, and depending upon how the IRS puts that in the regulations, to show the taxpayer qualified to claim the credit. Obviously, one of the key issues involved is you have to have actually paid the tuition during the year in question, and you have to meet certain other requirements. The 1098-T, when it was going to show the amount paid, would have obviously made it much easier, especially since this year you have to have a 1098-T in order to claim the credit. So you'd ask your client for a 1098-T. You have that T. It has the amount paid. You basically have a lot of the ground covered before we get started with the next point. Now the problem is going to be we're going to again get a 1098-T, which we are going to need to know that's been issued, but that 1098-T will not have the amounts paid necessarily, and we're still going to have to make inquiries apparently of our clients, which we always have. We're going to have to document those inquiries and potentially be subject to a $500 penalty if you can't show that you made reasonable inquiries on that issue. Again, it's going to complicate, and with heftier penalties, this may cause concerns. It is not clear if the service will grant any sort of relief or any sort of special rules for the first year of the due diligence rules because they've granted this relief to the institutions, but I'd certainly keep my eyes open. Again, in theory, that didn't change anything. So in the past, you always should have been asking, what did they pay? But this year, if it turns out you can't document you did, you may be writing a $500 check if it turns out your client was not eligible to claim the American Opportunity Tax Credit. This has been the current federal tax developments for the week of May 2nd, 2016. Be sure to join us next week here on this podcast, where we'll talk about developments that take place during that week. You can also visit us online at currentfederaltaxdevelopments.com. There you will find the write-ups back behind all of the things we discussed this week. You'll also find a PDF that will give you information that actually gives you the write-ups all the way for every story I just discussed. You can download that PDF from the website. We'll also give you updates during the week as things happen. Also, be sure to check your state CPA society. Their catalogs are out now. You can sign up for your continuing education. Be sure you take a look at doing that. We would love to see you in live courses here. I'd love to see you as I go out and travel around the country, see what you're up to, and we'll talk to you in person at these sessions. So be sure you do that. And we'll go ahead and we will see you next week here on Current Federal Tax Developments.